Jake buys a rental duplex with his retirement savings. Marcus puts the same money into Dividend stocks. They're both 62 years old. They both spent 30 years working, saving, and being careful with every dollar. They both have exactly $300,000 sitting in the bank, and they both think the other guy just made the worst financial decision of his life. They're both wrong, because neither of them ran the numbers the whole way through retirement. Not year one, not year five, the whole way through. Every cost, every tax, every hour, every repair bill, every market drop, all the way to the moment they actually need to live on this money. And when you do that, the gap is not what either of them expected. Welcome back to Nate Invests. We do one thing here. We run the actual numbers so you're not guessing with money you spent a lifetime building. Let's keep this completely fair. Jake and Marcus are both 62, both planning to retire at 67, 5 years from now. Both lived in the same mid-sized American city for most of their adult lives. Both earned around $75,000 a year during their careers and saved with real discipline to get to this $300,000. Same age, same city, same savings, same goal. Turn that $300,000 into reliable income they can actually live on for the rest of their lives. The only difference is what they do with it. Jake uses $60,000 as a 20% down payment on a $300,000 rental duplex, 2 units, solid neighborhood, decent condition. He finances the remaining $240,000 at 7% interest on a 30-year mortgage. His monthly principal and interest payment, $1,597. His plan is simple: 2 tenants, 2 rent checks, a real asset he can see, touch, and eventually leave to his kids. The other $240,000 from his savings, Jake parks it in a high-yield savings account. He'll figure that out later. Marcus takes all $300,000 and splits it across 2 positions, a dividend growth ETF and a high-yield dividend ETF. No tenants, no maintenance calls, no keys to hand over. He sets up automatic reinvestment and doesn't touch it again. On day one, Jake looks like the smart one. He owns something physical, something real. He can drive past it on the way to the pharmacy and say, "I own that building." He's a landlord now. That has a certain weight to it. Marcus has a brokerage account and an automated confirmation email. Nobody has ever impressed anyone at a retirement party with the brokerage confirmation email. But impressing people and retiring comfortably are 2 entirely different problems.
For the first year, Jake is living exactly the life he imagined. Both units are occupied. Unit A brings in $1,200 a month. Unit B brings in $1,100 a month. Total, $2,300 every month, landing in his account like clockwork. His mortgage is $1,597, property taxes roughly $300 a month, landlord insurance about $175 a month, total monthly expenses $2,072. That leaves $228 of positive cash flow every single month. Jake mentions it at dinner. He tells his son. He texts a friend from his old job. The duplex is already cash flowing. Meanwhile, Marcus's $300,000 in dividend stocks is generating roughly $10,500 in dividends during year one, about $875 a month, which gets quietly, automatically reinvested back into the same positions. His total portfolio ticks up to about $322,000 by year's end. Nobody asks Marcus about it. Marcus doesn't tell anyone. Jake feels like he's winning, and on the surface, he is. But there's something neither tenant has broken yet. There's no emergency call in the night, no surprise inspection, no difficult conversation about late rent. Jake has been lucky. Year one is always the easy year. Let's run the actual numbers through year 3. Jake has collected roughly $82,800 in gross rent across 36 months. His mortgage, taxes, and insurance have cost him $74,592. That's about $8,208 left over before anything else touches it. Then the water heater in Unit A dies. Not the old water heater, the relatively new one. $1,400 gone. The furnace in Unit B starts making a sound no furnace in a functioning duplex should make. replaced, $3,200. Gutters on the left side of the building were flagged by a contractor, $900 to fix before the spring rain turns them into a problem. At the end of year 2, the tenant in Unit B decides to move closer to her family. 1 month of vacancy, $1,100 in lost rent. Cleaning, minor repairs, relisting, screening applications, signing a new lease, another $600 out of pocket. Jake is still positive, but that $8,208 in apparent cash flow over 3 years has been carved down to roughly $2,108. That is not $228 a month. That is $700 a year. That is $58 a month on a $300,000 investment after 3 years of being a landlord. Now look at Marcus. His $300,000 has grown to approximately $358,000. He's reinvested $32,700 in dividends without spending a single hour managing anything. He made no phone calls. He handled no tenant concerns. He replaced no appliances. But Jake still has something real working for him. The duplex has appreciated. At 3.5% per year, it's now worth around $332,000. His mortgage balance has dropped to about $233,000. His equity, what he actually owns, is roughly $99,000. That's not nothing. That's leverage doing its job. So at year 3, the scoreboard is complicated, and that's exactly where most people stop running the numbers. We're not stopping there.
Here's what that $228 a month never told you. That number is the gross rent minus the mortgage, taxes, and insurance. It's the number on the back of the napkin. It's the number that makes the duplex look like it works. What it doesn't include is the full, real cost of owning a rental property. And on Nate Invests, we include everything. Vacancy. On average, rental units sit empty about 1 month per year. Every month the unit is vacant, the mortgage is still due, the insurance is still due, the taxes are still due. The rent is just not there. On a duplex, you'll likely face this at least once a year across both units combined, and every transition between tenants costs money in cleaning, advertising, and your time. Maintenance and capital expenditures. The industry standard is to budget 1% to 2% of the property's value per year for maintenance and capital costs. On a $300,000 duplex, that's $3,000 to $6,000 every single year. Some years it's a $20 faucet. Other years it's a $9,000 roof you cannot delay because your tenant is threatening to call the housing inspector. Here's the part that matters for someone planning retirement specifically. These repairs don't schedule themselves around your life. The boiler doesn't wait until after the holidays. The foundation crack doesn't pause where you're visiting your grandchildren in another state. At 65 or 68, coordinating emergency repairs is not just a financial burden, it is a physical one. Property management, the choice you don't really have. Right now, Jake manages it himself. That means answering maintenance calls, running background checks, doing walkthroughs, filing paperwork, coordinating contractors during business hours. That is a part-time job, one with no salary, no benefits, no paid time off, and no retirement date. Eventually, and almost every landlord reaches this point, Jake will want to hire a property manager. The going rate, 8 to 10% of monthly rent. On $2,300 a month, that's $184 to $230 a month, subtracted before Jake sees a dollar. Tenant risk, the number nobody advertises. In most states, a tenant who stops paying rent and understands the eviction process can remain in your property for 3 to 6 months before you can legally remove them. During those months, you receive no rent. You still pay the mortgage, you still pay insurance, you pay an attorney. One bad tenant situation can eliminate an entire year, sometimes 2 years of positive cash flow in a single event. None of this is in the $228. None of it is in the brochure. All of it shows up eventually.
Now let's look at the real scoreboard at year 10. Jake has managed the duplex for a decade. He's been through 3 tenants in Unit B, 2 in Unit A. He's raised rents. Unit A is now $1,450. Unit B is $1,350. Total $2,800 a month. That part's good. But property taxes were reassessed twice. Insurance went up. He replaced part of the roof in year 7, $8,500.
1 month completely vacant across both units during a particularly difficult turnover. He hired a property manager for 8 months while he was dealing with a health issue in year 8. $184 a month, gone. After 10 full years, adding up all gross rent collected, subtracting every real cost, mortgage payments, taxes, insurance, all repairs, all vacancy losses, the property management stint, Jake's total net cash flow from the duplex over a decade is approximately $19,000 to $26,000. His equity, though, tells a different story. The duplex is now worth about $423,000. His remaining mortgage balance is roughly $213,000. Equity, approximately $210,000. If we add the equity to the cash flow, Jake's total wealth position from the duplex is around $229,000 to $236,000 after 10 years. Now look at Marcus. His $300,000 in dividend stocks, growing at a conservative 7% average annual total return with dividends reinvested the whole time, has reached approximately $590,000 at year 10. He spent those 10 years doing nothing. Not one phone call, not one contractor visit, not one difficult conversation about a lease clause, not one 6 a.m. text message about a broken pipe. His number went from $300,000 to $590,000 while he was living his life. Marcus is ahead, but Jake still has that $240,000 he parked in savings on day one, now roughly $275,000 with interest. Jake's total net worth is around $504,000 to $511,000. Marcus, $590,000. Jake, around $507,000. Close. But what happens next is where this conversation stops being about numbers and starts being about life. They're both 72 now, both officially retired, both drawing from their investments. And here's the question that actually matters at 72. Not which one is worth more on paper, which one is actually giving you money to live on right now. Jake's duplex, after 10 more years of appreciation, is worth approximately $598,000. His mortgage is nearly paid down, about $140,000 remaining. His equity, around $458,000. His net monthly income from the property, after expenses, after the property manager he now relies on full-time, after ongoing maintenance, is roughly $650 to $850 a month. $650 to $850 on a $458,000 asset. And it still requires decisions, still requires coordination, still requires his attention, even if someone else makes the calls. Marcus's $300,000 has been compounding for 20 years at 7% annually, with dividends reinvested the whole time, has reached approximately $1.16 million at year 10. His annual dividend income at a 3.5% yield on $1.16 million is roughly $40,600 per year. That's $3,383 a month, deposited automatically into his checking account. No maintenance decisions, no tenant screenings, no property manager to supervise. And if Marcus ever needs emergency cash, a medical procedure, a home modification, unexpected health for a family member, he can sell a portion of his portfolio in one afternoon. No listings, no negotiations, no agent commissions, no 60-day closing process. His money is liquid. Jake's money is locked inside walls. Now, and this is the part of the video I have to include because I won't give you half the story. If I only showed you the downsides of real estate, I'd be doing what most financial channels do, picking a side and pretending it's analysis. Real estate has genuine advantages that dividend stocks simply don't offer. Leverage. Marcus used $300,000 to control $300,000 in assets. Jake used $60,000 to control $300,000 in property. That 5-to-1 leverage in the early years accelerates equity growth in a way that straight cash investing cannot replicate. When the property appreciates, the gain applies to the full value, not just the down payment. That math is powerful. Inflation works for you. As inflation rises, Jake's rental income rises with it. His mortgage payment stays fixed. In year 15 of a 30-year loan, that fixed payment is being serviced with dollars that are worth significantly less than the dollars he borrowed. The tenants are paying down a debt that gets cheaper in real terms every year. That's a structural advantage. Depreciation. The IRS allows landlords to depreciate the value of the building, not the land, over 27.5 years. On a $300,000 duplex where $240,000 is attributed to the structure, that's roughly $8,700 a year in paper losses that can offset rental income. Done right with a good accountant, a property that generates positive cash flow can show zero taxable income on paper. That is a legal tax shelter that dividend investors do not have access to. Control. Jake can renovate. He can add a deck, modernize a kitchen, increase the rent on a fully updated unit, and force the value higher through his own decisions. Marcus has zero influence over what the companies in his portfolio do. Real estate is an investment where effort and skill can directly improve returns. Legacy. A physical property is something Jake can leave to his children, potentially with a stepped-up cost basis that eliminates decades of embedded capital gains. That kind of generational transfer has real structural advantages that a brokerage account handled differently cannot always match. Real estate is not a bad investment. It is a misunderstood one, and for the right person in the right market, it is a genuinely powerful one. But here's when dividend stocks win, especially if you're watching Nate Invests, especially if you are in your 50s, 60s, or already retired. You want income that doesn't require a second job. A dividend portfolio sends you money whether you're healthy, traveling, resting, or in recovery. Rental income requires decisions even when you hire someone else to make the calls. The management layer never fully disappears. You want flexibility when life changes. At 68 or 72, financial flexibility isn't a luxury, it's a survival tool. If Marcus needs $40,000 for a serious medical expense, he sells a portion of his portfolio in one session. If Jake needs $40,000, he either takes on new debt against the property, waits months to sell it, or watches that money sit in equity while he figures it out.
You want your time to actually be free. Being a landlord is work. The calls don't stop when you retire. The repairs don't pause because it's inconvenient. For someone who built a career over 30 years specifically to stop working, trading one set of responsibilities for another is not retirement. It is a second career with a different title.
Your time horizon is different now. When you're 35, you can absorb a slow start. When you're 62, with a 5-year window to retirement, the early years of a mortgage, when almost every payment goes to interest, when equity builds slowly, when the break-even point on closing costs is 3 to 5 years away, that math is different. The window is shorter. The cost of a mistake is higher. And there are specific situations where real estate wins decisively, not in general, in specific. If you find a market where monthly rent equals at least 1% of the purchase price, that's the baseline most serious investors use, and you're willing to operate it like a business rather than a side project with real tenant screening, real capital expenditure reserves, and real systems, the leverage advantage can produce returns that a pure stock portfolio won't match over 20 or 30 years. If you're a high-income earner who has maxed every retirement account and looking for a legal place to shelter additional taxable income, the depreciation strategy is genuinely powerful. A skilled CPA plus well-structured real estate can reduce your taxable income in ways that dividend portfolios simply cannot. And if the property is close enough for you to manage yourself with minimal friction, meaning you have the health, the interest, and the time, the cost savings over decades are real. The self-managing landlord who loves the work builds wealth faster than the one paying 10% off the top in management fees. The people who win with real estate are not the people who bought a duplex and hoped. They're the ones who studied it like a business, prepared for every cost that doesn't show up in the headline number, and held it long enough for the leverage to do its work.
Let's put the full 30-year picture on the table. Jake holds his duplex for 30 years. It's paid off. It's worth somewhere north of $700,000. His equity is real. His kids may inherit it with favorable tax treatment. If he ran it well, managed every vacancy, navigated every repair, and kept tenants in both units for 30 years, his total net cash flow above all expenses might be $80,000 to $120,000 over that entire span. That's real. That's not nothing. Marcus holds his $300,000 in dividend stocks for 30 years, reinvesting at a 7% average annual return. His portfolio grows to approximately $2.28 million. His annual dividend income out of 3.5% yield is roughly $79,800 per year. That's $6,650 a month, automatically into his account. No decisions required. And his $2.28 million in liquid assets gives him the ability to respond to anything life throws at him in retirement. Medical costs, family needs, inflation, a market downturn, without having to negotiate with a bank or wait for a closing date. The difference in total wealth after 30 years is substantial. The difference in the experience of that 30 years is its own kind of wealth that doesn't appear on any balance sheet. Jake and Marcus both walked into their decisions thinking they'd done the math. Jake looked at 2 rent checks, subtracted a mortgage payment, and called it positive cash flow. Marcus looked at a 30-year average stock market return and said that number goes up over time. Neither of them asked the real question. Not what does this pay me next month? What does this actually cost me and give me across a retirement that might last 30 years? The real trap is not real estate. The real trap is not dividend stocks. The real trap is making a $300,000 decision, a decision that shapes the next 3 decades of your life based on one number without ever mapping out what it actually looks like when it's all over. If you're closer to retirement than you are to starting out, that calculation looks different than it did at 35. The questions are different, the risks are different, the value of your time and your peace of mind are different. That's what we do on Nate Invests. We run the whole thing. Subscribe so you don't miss the next one. Because if you're wondering whether it's too late to build a dividend income stream that actually covers your retirement expenses, we're going to run those numbers next. And the answer might be different than what you think. For now, the next time someone tells you real estate always beats stocks or dividend stocks always beat real estate, ask them one question. Did you run the whole 30 years? Because that's the only number that matters.